Hello.
Oh, oh,
So you probably noticed we have a different screen. We updated our presentation for 2026. Um, we're going to do things a little bit differently, dig a little deeper into our investment philosophy. I'll talk a little bit today about my investment thesis for 2026, and we'll look at our first topic. But I guess we'll go ahead and jump in. So, as I said, one of our big themes is going to be why we invest the way we do. And I think that's an important theme for 2026 because this really is a transition year from what I believe to be a traditional investment model to a huge transition in how our banking system works, AI, cryptocurrency, the powers around the world, how things are changing. And so, how we invest in that type of market, I think, changes a little bit. And so, I want to discuss what we look at, why we look at it over the next several months. So our first one is talking about valuation. So we'll talk about that today, how we actually value investments, specifically stock market. Next, we'll get into the high valuation investing, meaning if things are overvalued, how do we invest in them? And then if they're undervalued, how do we invest in them? Raising the floor means basically how do we play defense? How do we eliminate the downside in what could potentially be a bad year? How do we make sure that we're not going down as much as the market? What kind of investments can we be in to prevent that? Importance of being on the right side of interest rates. So everything in a fiat economy, and just to kind of explain what fiat is fake money, basically. It's a promise to that a piece of paper is worth something. And so the dollar is an example of a fiat currency. It's not based on gold or anything that has a true physical value. And the importance of being on the right side of interest rates in a fiat currency is important because you're either earning interest or you're paying interest. And you're either owning debt or you're selling debt. And if you're on the wrong side of that, you're actually losing money over time. So, a perfect example of that is if you keep money in your savings account. Most people think, oh, I'm earning interest. And the truth is, you are, but you're earning it at a slower rate than what you're actually paying in interest as far as the value of your dollars going down. So I saw this the other day. The dollar has lost 10% of its value just in the last couple years. That's a huge amount of inflation. Now, we've seen those inflation rates come down, but they never go backwards or very rarely go backwards. You don't gain some of that value back. So, making sure you're on the right side of that interest, earning interest that exceeds inflation and keeps your income and your net worth going up in value rather than going the other direction. The importance of alternative investments, or what I like to call non-correlated investments, things that move in different directions. So if the stock market's going up, this may go up or down. If the stock market's going down, it may go up or down. There's no correlation. So not all of your baskets are getting dropped at the same time. And then finally, the importance of cash flow. So most of you, if not all of you on this call, are retired at this point. So you don't have the income coming in as you did when you were trading your time for money. Oh, now how you're earning money is earning interest on the investments you have. And so being able to keep that cash flow coming in and replenishing your accounts as you go is extremely important. So we'll do a deep dive into all of those things over the next several months. But today we're going to talk about valuation and how we tell the market.
these were the slides that you were talking through. I didn't want to do it while you were talking, but these were what you were explaining while you were explaining them, and I didn't want them to be a distraction, but this
Oh,
is
go ahead.
actually
Okay,
where we are supposed to be.
got it. Okay, valuation. So one of the major things that we look at is should we be buying or should we be selling? And there's never really a time, and specific to stocks, there's never really a time where you don't want to be in stocks. It's a measure of how much do you want in stocks. So to give you an idea, right now, the market is extremely overvalued. It's expensive. If you look historically at the all-time valuations according to the Shiller PE ratio, we're at the second highest point in history. Um, and what's unique about the Shiller PE ratio is it doesn't just look at the the valuation just based on today. It actually looks back over a 10-year period. So it doesn't have as much volatility to it as a normal PE ratio might. So it kind of smooths out some of the bumps. So when there are bumps, it really lets you know what the status is. So on this next slide, we should see the PE ratio, the Shiller. And you'll see if you look back, I don't know if you can see my cursor. So right here is right before the Great Depression. We're coming up on the 100-year mark of the Great Depression, 1929. And not to scare anybody, but a lot of the same things are happening today that were happening then. What we're not seeing now that we saw at the very peak of this valuation is leverage. So, what a lot of people have done and do when they're investing, they start to get FOMO. They fear that they're going to miss out on the opportunity of investing, and they start leveraging. They start borrowing against the stock they have to buy more stock, or they borrow against their house to buy more stock. They just buy more and more and more. And that's a big sign of when we're getting to and nearing a top. And so we're not quite there yet, as far as I can tell. So you'll see we're actually at a much higher valuation today than we were then, not quite as high as the dot-com bubble. Now, what was unique about the dot-com bubble is you had all of these companies based on internet that had zero earnings. And so you have $100 stock that isn't earning any money. So it can never replace its value. We have something similar going on today with a lot of these AI stocks, where you have somebody betting on a future and we don't know exactly what's going to happen there. That being said, where here it was about a 5 to 10 year period before you knew who the winners are. I think in this scenario, because of the absolute speed of AI and supercomputing and things that are coming online very quickly, you're probably looking at a 2 to 3 year cycle to actually figure out who the winners are. So I do think we're probably going to keep going up on this trajectory for a while. We may pull back a little bit and then go up higher and pull back and go up a little bit higher. All of that being said, that does not mean that the market's fairly valued, because it certainly is not. It's certainly overvalued. And so when that happens, we don't want to be fully invested in the stock market as we would if the values were reasonable. So again, a single year, it can be misleading because you can have huge volatility. So having that 10-year buffer in the Shiller PE ratio helps us really see where the extremes are. And we're in one of those moments now. Again, it tells us when to buy and maybe when to start taking profits. The mix that we use, and I will detail more of this in future conversations, but the mix that we use when the stock market is overvalued is we want to have about 25% of the portfolio in stocks. That's our offense. That's where we try and get our gains. Historically, what we'd use is the S&P 500. We still use that but we also mix in some other stocks. So some of you are invested in AI and crypto, and both of those have done well. And I think will continue to do well into 2026. As we get into some of the philosophy or the uh, thesis on how we're investing, I'll give you a little bit more detail on where I think that's going. But I think this is the perfect metaphor. So if you live in an area where houses are normally about 500,000 and today they're going for 350,000, that gives you a pretty good idea that it's going to go back up to 500,000 and revert to the mean. And if they're selling for 900,000, you may never see 500,000 again, but chances are you're going to be stuck in that range. You're not going to have a lot of growth at that point. And so what we look at are those means. And specifically with the Shiller PE, we're able to see, okay, it's at a very high point right now. We don't want to be buying a lot. We want to keep our exposure low. And when it comes down and becomes fairly valued again, then we can buy more aggressively. Okay, so 2026 investing thesis. Um, Assets will likely have a big year, and that actually includes most asset classes. And there's a lot of reasons why, but gold, silver, copper, real estate, those are all what I would call physical assets, but also defensive assets. They're assets that when inflation goes up, they typically do well. For those of you who have been involved in previous calls, we've seen silver go through the roof. Um, Back in October, we were buying it at about 50 an ounce, and it broke above 92 an ounce today. So it's almost up 100% just since October. I do anticipate that that will continue in the first part of this year. Gold will continue to go up. I've added copper because as far as silver is needed for all of these technologies, copper is needed just as much as if possibly even more. And it hasn't seen the same price appreciation that we've seen in silver. So that's an asset that I'd like to start adding to folks' portfolios over the next few months. So I'd love to talk to each of you individually about it and how we go about that and why it might make sense. You all do have exposure to real estate within your portfolios, at least to a small extent. 5% is generally about what we keep in the portfolio. Pardon me. Digital assets. Bitcoin, Ethereum, Solana, and XRP. All four of those have been recognized within the financial industry and now have exchange traded funds. And they all have what are called treasury companies, where there's a company that's sole purpose is to own that asset and then create ways to make money on that asset. So the biggest example of that is MicroStrategy, or now just Strategy. And they are a Bitcoin treasury company. They actually just put another 1.3 billion into Bitcoin recently. So I believe they're up to about 682,000 Bitcoin. They're by far the largest holder of Bitcoin in the world. They are a company that if you think Bitcoin is going to do well and you don't want to own the physical coin, or you don't want to own the ETF, but you want to have someone who's managing it and creating ways to earn income on it, that's an example of a way to do that. So what we're seeing is a lot of the wiring and rails that the current financial system work on are changing. And we had the Genius Act come out last year. We're likely to have a new crypto act come out this month or sometime in this first quarter that structure how these coins and blockchains can actually be utilized. And that could potentially open investors, much larger investors, to be able to invest in those types of investments. So it might be worth adding some of these exchange traded funds in small percentages to kind of offset some of the risk in the stock market, again, as a asset that's non-correlated to the stock market. And then, of course, our traditional assets, stocks and bonds. Again, I think all of these are going to go up over the next year. And here's why. The Fed has begun quantitative easing, which is basically printing money and effectively making bonds less attractive. What that means is they start buying bonds, treasury bonds, on the open market, taking them, making them less available, and theoretically driving up the price and lowering the interest rate that you get on them. And that pushes people to invest in a more aggressive way. So if interest rates aren't attractive enough in treasuries, you start to look at other investments, and it pushes you up. If there's a spectrum, it pushes you up the risk spectrum to riskier assets, which drives those asset values up. The Fed has been cutting interest rates, again, making bonds less attractive. It makes the bonds you already own more attractive because they have a higher interest rate. So that drives the price of those bonds up. And again, driving you towards those higher risk investment assets. And when I say you, I don't mean you. I mean, it drives the market in that direction. Tax returns on the new big, beautiful bill should start hitting in February, March, April. They're expecting somewhere around 3 trillion in tax returns this year. That's 3 trillion of liquid assets that are going back to individuals that theoretically will go back into the economy and drive things. And then there's also another 3 to 10 trillion in liquidity added to the economy through that quantitative easing. So we should have a huge first quarter where all of this liquidity comes in. When liquidity comes into the market, a certain percentage of that goes towards assets. And historically, when you have that, asset values just continue to rise. So we should see that first, second quarter of this next year. The stock market will likely have a correction, potentially in the third or fourth quarter of this year, could stretch out into 2027, could be beyond that, depending on what happens going forward. So anyway, the market will likely come down. And what that does is create a great opportunity for us to be able to buy when those valuations are low. That's when Warren Buffett buys. So again, in the third month, we'll talk about buying when valuations are low. Inflation could temporarily affect the consumer. We could see a spike in inflation somewhere along the way. Anytime you add a ton of liquidity, it could drive prices up. So far, what we're seeing is inflation has been pretty steady, and I attribute that to a few things. The cost of energy is low right now, so the cost of shipping things and moving things from place to place is low. The cost of building things is low. You also have a number of consumers who have left the market. You have about 2.5 million people who have left the country, either on their own accord or forcibly. And so you have fewer people trying to get the same amount of things. And that ultimately helps inflation. AI could slow hiring, and immigration policy could protect jobs. When you have fewer people looking for jobs, it means even though there might be fewer jobs available due to AI, that we could see the jobless claims stay the same or even go down over that time. The Jevons paradox or effect, this is an example of where you expect one thing. So for example, with AI, we expect it to take over a lot of jobs that people are doing currently. And concrete is an example of this. Early on, when concrete was invented, it was expected to take a lot of the jobs of individuals who used to do construction. And what actually happened was, because it was such an effective tool for building, it allowed us to build much larger, much sturdier structures. It allowed us to build 50, 60, 70, 80 story buildings, which required more people to actually build. So there's a possibility that AI has the same effect, that it creates an opportunity for more jobs in more important areas because it replaces the lower level jobs. So we don't know if that's going to be the case. We won't know for a while, but there's a distinct possibility that that could happen. And then finally, for those of you in California, there's a big wealth tax going on, or discussion about a wealth tax, and whether it makes it on the ballot in the next year or two. It will likely not affect anybody here directly, but anybody here in California indirectly. If you plan on sticking around, it could affect you. So Sergey Brin, one of the founders of Google, he has an estimated net worth of about 100 billion. Most of that is shares of Google, and most of it is shares that give him extra votes versus ordinary shares. And according to the current wealth tax proposal, his net worth based on those voting shares would be 1 trillion. So even though if he sold his shares today, he'd get 100 billion, California is saying they're worth 1 trillion because he has those extra voting rights. The 5% tax on that 1 trillion would be 50 billion, or half of his actual realized net worth. And he would actually need to sell all 100 billion to pay the 50% income tax and the 5% wealth tax, leaving him with nothing. What does this do? It creates a scenario where wealthy folks in California are leaving and have left and don't want to be any part of this law. Many of them pay the lion's share of the taxes here in California and are comfortable doing that under the current scenario. But with this new wealth tax, it will actually drive them out of the state. And many of these folks already have left just because of the potential for this to go through. Sergey, in particular, has actually moved many of his LLCs into Nevada and Delaware to avoid some of this potential risk to him. Now, if all of these people start leaving, the people that pay the majority of the income tax in California, and we want to continue to have all the benefits and state programs that we currently have, and all the people that are benefiting from those programs stay because they have no reason to leave, that tax eventually moves down to individuals like you and I. They have to get the money somewhere. And if they need to fund programs using California taxpayer money, eventually you and I start paying for that. So that's why I say indirectly, it could eventually become directly that we're paying for it. So where it's potentially a good idea to be able to tax individuals, wealthy individuals, I think this structure is a bad idea and causes more issues than it solves. So that's it for today.
Matt, my understanding is that billionaires don't touch their assets, but they borrow based on using their assets as collateral. And they're not actually selling stock, so there's no way to tax them on that. So would it not be wiser then to just tax them when they borrow money based on their assets?
I think that has been suggested at times. I don't know that I've seen any recommendations about that, but I think that would be an idea of a solution where you don't force somebody out of the state. Absolutely.
Because we do need to adjust the situation, because when you have 1% owning 80% of the assets, it's an unhealthy situation. It's going to end up with a revolution eventually.
Yeah. And I think if you're valuing something at 10 times what it's actually able to be sold for, that creates an issue.
Yeah.
Um,
Yeah, that's the other thing I wanted to ask you about. Tesla and Nvidia, these things are just so overvalued and not really earning now.
I agree. And they could be some of the biggest winners 2 or 3 years from now. They may be considered cheap 2 or 3 years from now. So that's why we have some exposure, but not huge amounts, because they could
And
very
my
easily be half the price they are today.
and my last question is, if interest rates do come down from whatever reason, maybe if Trump puts in his person and he forces interest rates down, will that have an impact on inflation?
It could. So going back to the original discussion months ago about tariffs, the economists like to look at things in a bubble. So if you look at tariffs, tariffs potentially can cause inflation, and tariffs on their own do cause inflation. But if you start to look at tariffs in conjunction with other things happening, like reduced spending and uh, immigration changes to where there's fewer people in the country, and changes in tax laws, as all of those different things pull different levers, it can balance out. So I would say it's the same in this scenario, where for anything that might cause inflation to go up, there's another lever that can be pulled to have it go down. And knock on wood, it seemed like this administration, and I give a lot of credit to Scott Bessent, they have been able to continue to grow the economy and add liquidity to the economy and not cause inflation. That does not mean it will continue that way, but that has been their MO so far.
How about the number of jobs created last month? It's like 50,000 or something. Is a very low number. What impact will that have on the economy? Or is that a product of nervousness on the part of employers?
I think it's a product of a few things. I think certainly waiting to see what the Fed's going to do is part of it, seeing what the liquidity is going to be. I think AI and some of the uncertainty of, do we hire people or do we invest that money into AI, is part of it. I think you've got a lot of people exiting government jobs. So all of the growth in the jobs market is in the private sector, which I think is a better sign of strength. Over the previous 4 years, I think 2 million government jobs were added, some number like that. So just getting back to where we were before that and cutting red tape, having tax dollars go towards things that are more efficient, I think all of those things are helpful. I don't know what that's going to look like. It seems like we learned something new, and there's changes along the way that just keep happening almost on a daily basis. So keeping up with all of those changes is kind of what I'm trying to do, and where I'm seeing things go is the big macro move that we have to pay attention to is the liquidity. There's a ton of liquidity, and so we want to play offense as far as staying invested in things that benefit from that, but we also want to play defense as far as the potential for inflation. So silver and gold are a perfect example of playing defense against that. I see the question on the screen. The answer to that is yes and no. So I have a broad list of stocks that I look at. None of them, or very few of them, are investable at the prices they're at now. So it could very well be that all of them end up being the right price at some point in Q3 or Q4. And it could be that just some of them are. But I'm constantly watching different sectors and different stocks. You're welcome. Anything else? Okay. Well, I appreciate you guys coming. Expect this conversation to grow and expand each month as we get further and as we learn more about what this government is going to do and has been doing.
I love the new format. Thank you.
We'll talk to you
Never.
guys soon.
Okay,
Thank
bye-bye.
Tracy. Thank Tracy. She's the one who did it.
Thank you, Matt. Thank you,
Yep.
Tracy.
I did something right. Thank goodness.
Have a nice day.
Bye.